Welcome to the first lecture of Accounting 101. This lecture will be an introduction to financial statements. In accounting, accountants prepare financial statements and people who read the statements interpret them. Financial statements can be used by management to understand how a firm is doing, or they can be used by investors who are deciding whether they wish to invest in a firm. Accounting is broadly divided into two parts: financial accounting and managerial accounting. Financial accounting is the correct preparation of financial statements according to the generally accepted accounting principles. The objective is to provide information to outsiders. Managerial accounting, on the other hand, is accounting with the objective of providing management with information about the firm, information about how the firm is doing to help management make decisions. So without wasting any time, let me get on to financial statements. The most common financial statement is the balance sheet. You've probably heard about the balance sheet. The balance sheet is composed of two lists. On the left side of a balance sheet is a list of assets, and on the right side of a balance sheet is a list with the name liabilities and owner's equity, or also called liabilities and stockholders' equity. So this is a sample balance sheet, and in this balance sheet, in the list of assets, we have cash of 100, inventory of 200, property, plant and equipment of 1800. So the total assets is 2100. On the right side of the balance sheet, we have notes payable. Notes payable are short-term debt of 100, long-term debt of 300, common stock and paid in surplus of 800, and retained earnings of 900. So common stock and paid in surplus is money invested by the equity holders in the firm. It is the amount of money which they have provided the firm in exchange for the equity which they have received from the firm. Retained earnings is a measure of how much money the firm has earned for its equity holders. So it is the earnings of the firm for equity holders which have been retained by the firm, which have not yet been paid out to the equity holders. Now, accounting has a set of important concepts and a lot of rules. If you understand the concepts, the rules will make sense and will be easy to remember. If you do not understand the concepts and you try to remember the rules on an ad hoc basis, then it will be much more difficult. So I'm going to introduce to you now the first concept, which is based on the question, why does the balance sheet balance? Well, I've asked this question to many of my students, some of whom have done accounting courses before I taught them, and I really have not received any satisfactory answers. Sometimes they say, well, if you do the rules right, then the balance sheet should balance. Yes, that is true, but it does not give you the intuition. It doesn't give you the concept of what is happening. Sometimes they say it's just a balance sheet, right? So by its name it should balance, but that doesn't explain anything either. Okay, so this is how you look at a balance sheet. A balance sheet has two lists. The list on the left is assets, which is easy to understand. Assets are things which are owned by the firm. Okay, so it's a list of everything that is owned by the firm. Now the list on the right side is named liabilities and owner's equity. So what is this list? This is actually a list of owners of the firm. Who are owners of the firm? Normally when you think owners of a firm, you think of equity holders. But if you expand the definition and you think of owners of the firm as being all the people who have legal claims on the firm, then the right side becomes a list of those claims. It becomes a list of those owners. So to think of the right side of the firm as a list of owners of the firm as all people who have legal claims on the firm. So once you look at the balance sheet in this fashion, that the left side is a list of assets of the firm and the right side is a list of people who have legal claims on the firm, then you can start to get the concept of why a balance sheet has to balance. Now, first suppose that the right side, the list of legal claimants, exceeded the left side, the list of assets. Why would this situation not be possible? So let us consider the example of a firm. Suppose you and I own this firm. That is, we have provided money to finance the firm. Suppose you have provided money by buying debt of the firm and I have provided money by buying equity. So we are the people, you and me, who have legal claims on the firm. Now, suppose that the assets of the firm are these pens, this cell phone, and this paper. So the firm has 3 assets and 2 owners. So let us make a list of the assets. Let's see how an accountant would do it. So they would say that, okay, there are assets which are the pen, and let's say the pens are worth $10. The cell phone worth $200, and the paper worth $5. So the accountant is making the balance sheet for the firm and has listed the assets and totaled the assets to 215. So the total for the assets is 215. Now suppose the accountant goes on and says that the value of the debt which you own, so this side is liabilities and owner's equity, and says that the value of the debt is $150. So the accountant is saying that what you own is worth 150 and what I own, which is equity, say the accountant says is worth $80. And the accountant adds it up and says that the total of liabilities and owner's equity is worth 230. Now, this is a balance sheet which is not balanced. And why can this not happen? Well, this cannot happen because on one hand, the accountant is saying that the firm is worth 215. On the other hand, the accountant is saying that the value of debt is 150 and the value of equity is 80. So the accountant is saying, between you and me, we own stuff in the firm worth $230. But also the firm is only worth 215. So that can't be, right? Either your or my ownership has been overstated. It's like I had $215 in my pocket and the accountant says that you and I own whatever is in my pocket and tells you that you're going to get 150 and tells me I'm going to get 80. That's not going to work. Therefore, the right side, which is liabilities and owner's equity, cannot be greater than the left side. What about the left side being greater than the right side? Well, that can't happen either. That cannot happen because of a class of owners called residual claimants, who are the equity holders. Suppose the balance sheet was so the assets of the firm are the pens worth $10, the cell phone worth $200, and the paper worth $5, for a total of $215. And suppose the accountant says that debt is worth $150, equity is worth $30, for a total of $180. Now this can't happen because as the equity holder, I'm the residual claimant. What does that mean? Residual claimant means that for this firm, whatever is not owned by somebody else is owned by me. So equity holders are residual claimants. They own all value of firm which is not owned by other claimants. Therefore, nothing in a firm can be left unclaimed. According to this balance sheet, there is $35 of value which is not owned by anybody. It's not owned either by you or by me. If you own 150, then I, as the residual claimant, must own 65. My share cannot be 30. Therefore, the liabilities and owner's equity, which is a measure of ownership of the firm, cannot be greater than the assets of the firm. So this cannot happen. nor can liabilities and owner's equity be less than assets of the firm. So this cannot happen either. Therefore, the two must be equal. The other way to think about this equation is that the owner's equity equals the assets of the firm minus the liabilities. This is probably the easiest way to think about it. The firm has some claims on it classified as liabilities and some of them classified as owner's equity. So the equity holders own whatever the value of the firm is minus all the claims on the firm which are classified as liabilities. So this is the first concept that you should have about accounting, that a balance sheet balances because on one side you have a list of assets and on the other side you have a list of claims on the firm, the value of these claims according to the accountants.